Okay, Sunil Subramaniam now joins us. Sunil, good to have you back, and really appreciate that you've accommodated today's interview request. For us, you've gone out of the way, and we've just called you 5 minutes before, and you've accommodated this. So thank you once again for that. Sunil, my basic question is that if I look at the index right now, and it is not because of Reliance, it's IT and to a large extent comeback in pharma. The index is up for 13 days, 7 days on the trot now. This is the biggest winning streak for the index in last 2 years, and yet there is no comeback in small and mid cap stocks. We did see a comeback in September in mid and small cap stocks. Post that, the comeback has not been very satisfactory. What does that tell you about the market health?
What it's telling me, Nikunj, is the two things. So one is that it's the liquidity surge abroad. The fact that the Fed has said that there's a soft interest rate regime for 3 years. The fact that there's about $13 trillion of liquidity going to be pumped in, and the world is coming back to a V-shaped recovery faster than India. So to that extent, when a FII is looking at it with cheap money, lot of money, for him, the export-oriented sectors of India, because they are going to benefit from the world revival faster than a domestic-oriented company is going to recover based on India's economic dynamics, right? So naturally, there is a heightened buying on IT and pharma, because with the V-shaped recovery, the work from home, the changing business dynamics on how IT plays a role, right? And that's the reason you're saying Nasdaq also perform. That's where the Indian IT companies, and I think Indian companies have been very smart in pitching themselves well from a consulting and internet-based approach things. I think they have been very quick on the uptake, and hence, from a FII perspective, clearly it's a much better bet than a commodity-oriented Brazil, Russia kind of a place, and a China which is going through its troubles with the developed world. So I think that accounts for that kind of a FII flow. And domestic MFs, if you look at it, right, while there is redemptions from the existing investors, new money is been coming in through NFOs a lot. And these are essentially large cap oriented NFOs. Whether you take our own blue chip fund, which raised about 650 crores, Principal has a large cap fund which just closed. Then there are various multi-asset funds where also the fund managers, going by their multi-cap experience, that they are going to be allocating more to large cap. So there is going to be large cap buying support from domestic MF to some extent. The third point here is that the whole multi-cap, the fear that fund managers will be forced to buy small and mid caps, and because of which there was a rally. That rally was not driven by buying coins, that rally was driven by shortage of liquidity, in the sense, if I'm holding a small cap stock as a player, when I see this news item, I think the fund manager is going to buy, so I dry up the liquidity from the market. I hang on to my stock, and that pushes up the price. But then, as we have realized, right, one is discussion with SEBI is on the whole thing. But even otherwise, fund managers are not going to just go and buy small and mid cap because SEBI has changed the rules. They have multiple options. A, convert their fund into a large cap or large and mid cap, or encourage their advisors, distributors, investors to switch to the large cap funds. It's only after these processes are gone through, the remaining, there may be a small spike in small and mid cap. So that initial thing saying that, oh, this SEBI regulation is going to lead to a huge drive up on small and mid cap has proved false, which is what I have also said on ET Now a few weeks ago. The third point is, like I said, India's recovery story is hinged upon this Diwali, number one, the budget, number two, to really see the V-shaped recovery happen. So I think for a domestic fund manager to take on more small and mid-cap exposure at this point of time, which sector to buy? Now, even within IT, you're going to see that internationally, the market is definitely going to favor the larger IT. Pharma, it's about the bulk drug supply, the vaccine or the cure seems to be around the corner. Sooner or later, we will get it. So Indian pharma will get a good business order book based on that. So I think that's the market participants are just playing safe and betting where there is a more certainty of earnings. And so I would say that to finally round it off, in good companies in good sectors defined as those where there is visibility, good companies, those which can grab market share, are going to get a higher and higher premium. So the polarization is probably going to sharpen in the short run, and it will take domestic economy's recovery to be on a firmer footing for small and mid caps really to come into favor with fundamental oriented mutual fund managers. Why I'm stressing this is this whole new demat account opening, Robinhood investors coming, buying, they are a hot money thing which is unpredictable. They may come into small pockets suddenly and you may see small rallies. But a sustainable growth in the small and mid cap space needs a clarity on the shape of the V, the strength of the V, and the speed of the V, the slope of the recovering V. So I think we will wait for the festival season, I think the market participants, to see how that really pans out. There is conflicting news on the virus itself. If you look at it, rural virus was spreading more faster than urban, but recently there is a slowdown. That's good news. So I think that, and I would say there is a January trigger of the harvest numbers. See, this rising inflation, which is a cause for concern, right? I think will ease with the Kharif crop coming into the market. So clearly, January, the RBI policy, where you have a softening inflation, if growth is still not clearly visible, another rate cut may come, in which case there could be a more broad-based rally. But till the thing that, and the ultimate point is that the US elections, right? Biden, while he's leading in the polls, and generally the market favors Trump, what we're also finding is that Biden himself is a smart, pragmatic player. So what he says in the run-up to the election to what he does post the election, market is predicting that there's really not much wiggle room for him to change anything. So a soft interest rate, quantitative easing kind of a program should continue in the US also. So I think the initial fears of the market of a Biden being anti-economy, anti-market, anti-business, and Trump only being pro, I think market is also a little bit at ease there. So that's why FI money is continuing to.
Right. Fair point. So Sunil, ultimately what matters is that what is in the price and what is not in the price.
Right.
All the stock markets, somewhere some would argue that they are already pricing in a good comeback in the second half and a great comeback next year. What, for whatever reason, whether it is second wave, political uncertainty because of US presidential election and the outcome of that, it could be pure liquidity, whatever may be the underlying factor, if the economic recovery is not as strong as what everybody is projecting, then what happens? Because right now markets are only focusing on two-wheeler sales have come up, white goods sales have started, electricity consumption has picked up, traffic or road traffic has picked up. While all those are encouraging signs, my question is that aren't markets getting too complacent?
I would tend to have a ambivalent view there in terms of both ways. So I'll look at it this way. Domestic participants, I think, are suffering from a frog in the well approach. What do I mean by that? Is that the frog can't see beyond its well and it's looking at it and saying, right, the wall of the well is too high, I can't jump over it. If there are these risks and I'm stuck in this. But for an FII, when he's looking at it, even if Indian economic recovery gets delayed, you look at it from a TINA factor. What is the alternative? There is no alternative to an FII but to buy growth. Just because that growth, instead of happening in 6 months, is going to happen in 9 months or 12 months, doesn't alter the fundamental thing of a pension fund, which has got a 5-year, 10-year, 15-year outlook, right? Yes, he will factor in that the recovery will take a longer time. So I think the vision, the glasses with which you see this whole thing, for an Indian player who, let's say, has bet on this recovery within a 6 months and then position a portfolio, yes, he's going to feel a little bit of a worry and maybe rejig it, say, oh, it's getting delayed, so let me rejig. But for an FII, a longer term FII, this doesn't matter. You are not talking that fundamentally there is something done wrong to the Indian economy. The COVID virus and the lockdown, right? Both are, what I would say, non-India specific factors. Right? Now, in that context, from a recovery post-COVID, now you're saying that recovery may take a bit longer, right? That's fine. But when that recovery happens, which is that country which is going to be at the forefront, I don't think there's a doubt that India has the potential to take over a part of China's position in the world as a supplier. It has the potential. The government is sincere. There is actions happening on reforms front. Despite opposition, they've used, one thing you can clearly see, right? They have used the whole opposition's focus around the virus and trying to find fault with everything to push through very significant reforms. They may be politically challenging, but economically, can you doubt that what they're doing on the farm bill, what they're doing on the land bill, what they're doing on labor reforms, are they all questionable? So when these go through, right, they are definitely, the fact is that it's only a matter of when and not if. I think that's the point to remember. So shorter term players will always reallocate portfolios based on this 3 months, 6 months. But a longer term portfolio, why should we get worried? Whether the recovery happens in 6 months or 9 months, in a 3 to 5 year time frame, it's all going to settle down. So I think that that's the key answer, Nikunj, is that in all of this short term polarization, you have to keep a perspective of the longer term. And even within, you're talking about small and mid caps, even within large caps, right? There is this polarization between economy sensitive sectors to export sensitive sectors, and export sensitive is winning the battle today. But the large cap economy sensitive companies are also going to recover. So you will see that they will lead the recovery there too. So I am not too pessimistic in terms of the fact that inflation footprint came in higher, IIP might come a bit lower. Those are all obstacles or small roadblocks on the path. I think the path ahead is fairly clear, and to the extent that as long as liquidity is there, the only risk to the market is drying up of liquidity and a change towards risk, the approach towards risk. In both, I see as being fairly comfortable around the world. I think the money flowing to risk is clearly happening. As the last one I saw, there's about more than $3 trillion sitting in cash funds in the US. So how long can they be without returns, right? Gold is again a panicky situation. Why? It's already run up a lot. What's the logic for more to run up? If there is more fear, if there is fear of high inflation, weakening dollar, I don't see that all as a very big now. So gold is more of now truly a safe haven parking zone, but it has a limit because it doesn't have a return. Whereas cash funds, which they are putting there, are money on the sidelines. And I think gradually, as it starts getting into risk, India will continue to get a fair supply of liquidity. So what you are saying in terms of which I summarized as good companies and good sectors, will continue for some more time, because I'd rather pay a premium for certainty than bet on timing of the recovery and then do that. So I think that's the thought process of a longer term market participant, which I'm also comfortable. I think that's the right way to approach it.
I just want to mark the markets before we move forward. Look what's happening after what looked like it's going to be a 12K start. We've completely reversed tide. 11,912, we're at the day's low, 70 points lower, and we're now down in excess of 0.5%. The intraday graph that I want to bring up on your screens is that of Infosys. After a 4% gap up start, it's now barely holding out in the green as we speak. In fact, Infi is now just scratching the surface at about 0.5% to 0.7% kind of gain. Not just that, look at what's happening with the rest of the IT pack as well. Starting off with the Wipro, which started off with a gain of roughly about 1%, has turned tide and back to its losing ways from yesterday. Remember, it was a 7% intraday dip that Wipro saw in trade yesterday, currently as well lower by another 3%. TechM is down 2.5%. There's TCS, which is lower by about 2%. So IT definitely weighing heavy on the markets. Even when it comes to banks, which were really the knight in shining armor yesterday, I can't say the same today, because as I see on my screens, HDFC Bank is down 1%, Bajaj Finance, ICICI Bank, Kotak, IndusInd, SBI, and remember these were the big winners in trade yesterday. So, it's a disappointing way the market has actually panned out. Cipla, Lupin, Torrent Pharma as well, seeing some spots of red or some choppiness actually. Bata, Idea as well lower. Though on the flip side, you're seeing some sporadic moves in Ashok Leyland. That's got to be a start today. It's up 5%. Petronet, LNG, MGL, but these stocks have taken a beating as well. Tata Steel and Tata Power are the ones which are actually holding up. And for the Nifty, we're barely holding on to 11,900 as we speak right now. Sunil, what would be your biggest sector overweights and underweights at this juncture?
I think IT and pharma, like the rest of the market, I'm not trying to bet against the market. So I think IT and pharma are continuing to be my very overweight positions relative to the benchmark.
Right, and underweights?
Pardon? What was the question? I missed the question.
What sectors are you underweight on or have a negative call on?
Well, for us, I think PSU banks, banking we are neutral, overall private sector. PSU banks, I think NBFCs at the small and mid cap space, we feel that will take some time to recover. We think that we do have, our view is underweight in terms of the industrials and the cyclicals, because we'd like to see, but we do hold significant positions because historically we've been overweight. So we are not changing that dramatically by going and selling down there, but our view is that it will take some time to recover. So in current terms of view, we are underweight, but actual positions in our portfolio are closer to the benchmark.
Sunil, when we're saying long term, are you looking at a structural recovery in light of that? Then what are the kind of pockets, that you would be looking at? Because, there are some extremely beaten down sectors. Would one look there from a valuation perspective, or would you look at it more from a structural growth story perspective?
So, see, because I'm in a mutual fund, I'm kind of in a position where I can't just only look at long term. While we generally tell our investors that come with a 3 to 5 year period, the regulator also mandates that a daily report card in terms of NAV versus benchmark is published. So when we take a balanced approach here, the blend between the growth and the value. So the value in India is a very different from value overseas, right? Value in India happens because liquidity dries up, and soon there is a rush for value and it goes up. So value is always a tactical play in India. So if you see long term, you can't buy a value fund and really run a value fund in India. Value is a tactical play, and that's a good play to play for a 18-month outlook, right? So that's the way I would say that whatever you said, beaten down sectors, I would only buy them if I see that in 18 months they're likely to be liquidity flowing into that. Because anything from a 3 to 5 year perspective, my position is very clear that India is a growth economy. Ultimately, FDI is going to come in. The government capex will take a little bit longer. Private capex will take longer, but foreign capex would probably lead the revival in the next year. And so, our classic cement, building materials, EPC contractors, those industrial cyclicals are my longer term bet. They are value bets today because the market is seeing cyclicals as high risk, right? That's the reason. But I'm not buying it for the value. I'm emphasizing that I'm buying it for the growth which I see will happen, and it's a matter of when and not if. So the beaten down sectors that I buy will be those not because they are beaten down in price, but because I see a longer term growth. So that's where, in answering your question, the filter that I always use is called GARP, growth at a reasonable price. So I don't buy a sector which doesn't have growth in it at any point in time. Like I said, value for value's sake is only a tactical ploy from a shorter term play. So for me, the second one where I see growth at a reasonable price today is banking. Okay, but because I already have a significant number of private sector banks and the larger NBFCs in my portfolio, I'm not necessarily going and buying, but my view is fairly bullish that the Indian economy's recovery will be necessarily a positive for the large, good quality banks and NBFCs, and hence that's something I'll look to keep adding as the V-shaped recovery comes into play. Right now I'm neutral in terms of the banking sector, but increasingly I'm looking to will add it on as the recovery comes through. So I would say the banking, broadly the BFSI space. You can look at the fact that is also now post-COVID, it's gone a good wicket because sensitivity to taking insurance has definitely increased, and potential per capita penetration is very low relative to the world. So insurance, asset management companies wealth management companies. All of these are also part of the BFSI play, and that's something that I will, from a medium term, again look at it from a GARP model and look to buy.
All right, Sunil, thanks so much for joining us this morning.
Sure.
Always a pleasure. We're going to take a very quick break on that note. Back in a moment.